Good morning everyone, can you hear me? Good morning. Okay, so we will start. So yesterday's lecture we were doing this chapter of bond valuation. Today is, I guess, lecture number 5 or 6, something like that, of bond valuation. In that we had reached module number 8 called as bond refunding. What bond refunding was all about, I did not tell you, but I gave you one example connected to inter-CA capital budgeting. The name of the concept is replacement decision. For that, I gave you one example. Let us read it. So, what is there in this example? Let's read. We bought a machine 3 years ago for rupees 50,000. Okay. Total life of machine is 7 years. Which means from today, this machine has a remaining life of, can I say, 4 years? Are you there, na? Today we are thinking of replacing this machine with a new machine whose details are given below. So they have given all these details to you, and then they say, should the machine be replaced? Now, as I told you yesterday and repeating again, you actually have two options in life. One option is the story 1 path that you can take. Second option is the story 2 path that you can take. Story 1 path is if new machine is purchased today, which means we go for it and we sell the existing machine. Story 2 is, we reject the new one and we continue the old one. Do you realize both are necessary for us to evaluate to understand whether we should replace or not? Now, do you understand? Let's say story number 1's NPV is X and story number 2's NPV is Y. We will say if X minus Y is positive, incremental na, if X minus Y is positive, we should replace. If X minus Y is negative, that means story 2's NPV is more, then we should continue with the old, we should not. So now what I will do is, I will first of all tell you what I mean by project details, okay? Okay. So I will talk to myself like this, okay, if new machine is purchased, then can I say there will be an initial investment that I will have to do today, resulting in a cash outflow. And do you realize, as soon as I do this initial investment, thank you. As soon as I do this initial investment, I also on the same day will sell the old machine, correct? Sale of existing machine, and that will result in an inflow. I hope you are able to understand. See, I go and I buy new machine today for rupees 1 lakh, I understand. But do you understand that at the same time now existing machine I will no longer require, I will sell it off. Okay, now the new machine is with me. This new machine, can I say, will last for 4 years, and for these 4 years it will give you CFAT. Okay, everyone clear? And at the end of the 4th year, can I say, we will be able to sell this machine and receive some salvage. I hope everyone is following. Huh? Ready? On the other hand, if I continue the old machine, then do you realize there is no initial investment here? Because to continue the old machine, I don't need to do any initial investment. In Inter, you must have understood now that this cost that you are seeing, okay, this cost that you are seeing has been already incurred by you 3 years back. It is, in our financial language, sunk cost. Have you heard of this term? Sunk cost. Anything which has already happened, irrelevant. Sunk. Huh? So whether we talk about finance or whether we talk about life, anything which has already happened should not be considered. You're understanding? It is sunk. Gone. Only we have to speak about today and what we can do for tomorrow. So now, do you therefore realize that this 50,000 is irrelevant number given to us? So if you continue the existing machine, no, do you realize that the life of this also is going to be 4 years only? In a sense, 3 years have already happened. No, total life was 7. This machine, can I say, will also give us CFAT for next 4 years. After continuing for 4 years, this machine will also result in some kind of salvage at the end of 4th year. Correct? So these are your, cash flows. Now in that, I'll do some marking like this: 0, 0, 1, 2, 4, 4, 1, 2, 4, 4. Any idea what these markings are? These are basically telling you at which year, at the end of which year all this is happening. Everyone clear? And what are these arrows? So what I do is, right arrow, this kind of arrow means outflows, and left arrow, this kind of arrows means inflows. Okay, so like that. Now apart from this, there could be more data like tax rate. One thing yesterday I forgot to give you: should the machine be replaced, okay, if cost of capital is 10%. Now you need this discounting rate to calculate NPV. So I will now write a common cost of capital 10%. So generally, students, there are 4 items which are commonly given. One is life. Life I already given 4 years. One is cost of capital, that is 10%. One is tax rate. Now tax rate, students, I am not taking here, unnecessary, don't want to complicate it right now. Tax rate I am not giving, and because tax is ignored, the 4th thing also I am ignoring, that is depreciation. SLM, WDV, what it is, depreciation I am ignoring. Everyone clear? Because I directly gave you CFAT only in the question yesterday. So if directly CFAT is there, then that whole table from cash revenues minus cash expenses, net profit before depreciation and tax minus depreciation, net profit before tax minus tax, net profit after tax, add back depreciation, cash flow after tax, that entire thing I am skipping now, for you are not doing capital budgeting right now. So I directly taking to CFAT. Okay. Now students, how do I now evaluate? Now see, I will tell you method 1. Okay, method 1. In method 1, I'll write Roman 1, calculation of NPV of story 1. Okay, calculation of NPV of story 1. Year, particulars, calculation, cash flow, discounting factor at the rate 10%, present value. Okay. All right. Now, do you realize there is something happening in year 0, there is something happening for 1 to 4, and there is something happening for 4. So I'll write here 0, 1 to 4 and 4. Can I say in 0, there is going to be, I hope you all understand, year 0 is the year of outflow, correct? And year 1 onwards is inflow. So in year 0, can I say there is going to be an initial investment in this particular project, in this particular machine, but there is also going to be sale of existing machine. Everyone clear? New machine, you can see na, year 0 there are two arrows, one is an outflow and one is an inflow. But because year 0 is a year of outflow, the inflow I am going to show as negative. Everybody clear na? Inflow I am going to show as negative, outflow I will show normally. Okay, in the calculation. So tell me, new machine when I buy, new machine, do you realize will cost me 1 lakh? But at the same time, old machine when I go to sell, I will get rupees 15,000 as salvage today. Everyone clear? So I will write down here that if I go for story number 1, I will have to spend 1 lakh to buy the new machine, but also I will get 15,000 rupees as salvage of the old machine today, and therefore can I say 85,000 rupees is my initial investment. Everyone clear till here? Net initial investment. Now with that, can I say I have knocked off these two items? Next, can I say I will tackle CFAT. As far as CFAT is concerned, can I say CFAT that the new machine will give you is 80,000 per annum. I will write here CFAT 80,000 per annum. Generally we make a working note for CFAT to calculate CFAT, but here I have directly given CFAT to you, so no need of any working note. And then okay, so with that I have knocked off this CFAT, and now what is left is salvage. Salvage, can I say, will come at the end of 4th year. Salvage, the new machine na, salvage after 4 years will be rupees 20,000 according to the example I gave you yesterday. So I'll write here 20,000. Okay, now discounting factor, this is 1, I hope you know that, and then I will say 1 divided by 1.1, 1, 2, 3 or 4, so this is 0.683 and this is 3.170. I will take the calci now. 85,000 I will do negative here. Okay, hold on. 85,000, then 80,000 into 3.17, and that is 2,53,600, and then 20,000 into 0.683, that is 13,660, and that will give you NPV at the rate 10% as 182,260. Everyone clear? 182,260. Now the mistake that one can do is, oh, if I go for a new machine, I am getting positive NPV. Let's go for new machine. Wrong understanding, because you also have to check what you would have got if you would have simply continued what you have. I hope you are understanding. That is story number 2 also we need to calculate now, cash flows. So I will remove these markings. Now I will do NPV for story number 2. So I'll take this. Ready? In that I'll write story number 2, Roman 2, calculation of NPV of story number 2. Okay, now in story 2, do you realize there is nothing going to happen at end of year 0? Everybody clear? In year 0 nothing is there, no initial investment, nothing. So this entire thing goes away, it's not there. In fact, I'll remove the year 0 also. Can I say for next 1 to 4, yes, CFAT is there. If I continue existing machine, it will give me a CFAT of 30,000 per annum, and salvage is 1,000 at the end of 4th year. So here I will write, okay, CFAT 30,000 at end for every year, and salvage 1,000 at the end of 4th year. Everybody clear? Let us see what NPV this brings. So I will say 30,000 into 3.17, this is 95,100, and this is of course 683, correct? 683, and MRC comes to 95,783. Everybody clear? 95,783. Tell me, should we replace or should we not replace? We should replace. Everybody clear? We will say here, therefore incremental NPV will be 182,260 minus 95,783. Okay, 182,260, and this comes to 86,477. And then I will say, since incremental NPV is positive, existing machine should be replaced with new machine. Everyone clear? Existing machine should be replaced with new machine. Done? So with that we finish the discussion to how to do incremental NPV in a replacement decision. But in inter-CNO, we don't present it like this, and in final also we will not be presenting like this. This is a long cut presentation. This is a presentation to give clarity. Now how do we actually present? I'll show you how I do it. Okay, method 2. So listen carefully. Method 2. In that I am going to write point number A. Calculation of incremental cash flows. Incremental cash flows means cash flows of story 1 minus cash flows of story 2. Everybody clear? We are not, see, NPV direct, here story 1 NPV separate, story 2 NPV separate, like that I am not doing. I am just calculating the incremental cash flows, and then on the incremental cash flows I will be doing NPV. Everyone clear? So in that I will say point number 1, at end of year 0 cash outflow. Listen carefully. I will write particulars and amount. Now first I will write the cash flow of story number 1. Are you all there? Story number 1. So story number 1 cash flows. Tell me, in year 0 in story 1 what will happen? There is an initial investment and there is a sale of existing machine. So I am writing here initial investment. Initial investment is rupees 1 lakh, and then there is a sale of existing machine, that is rupees 15,000, and that will give you 85,000 rupees as the net initial investment. Everybody clear? Correct? Can I say this is the initial investment or year 0 cash outflow of story number 1? From this I will have to subtract cash flows of story number 2. I hope you are understanding. But in story number 2 there is no cash flow as of year 0, which is why the incremental cash outflow will come to 85,000. Everyone, are you all able to understand? 85,000. Why this clarity is required? Sometimes people in inter-CA, if they are slightly misguided, they think, oh, new machine 1 lakh, old machine 15,000, incremental 85. This is wrong understanding. 85,000 is not incremental. 85,000 is the cash flow, net cash flow of story 1. Incremental also became 85 because this 0 was there. You are understanding what I am trying to say? Nobody talks about this. That is why there is a lot of confusion in replacement. Anyways, moving on. So now we got end of year 0 incremental cash flow. Now students, do you realize, just as we did end of year 0, like that we will have to do for 1 to 4. Everyone clear? We will have to do for 1 to 4. So I will write here at end of years 1 to 4 CI. Okay. Now students, please understand, I am clubbing 1 to 4 because all data of 1 to 4 is given on per annum basis. If 1 or 2 or 3 or 4 would have been separate, no, then year 1 separate calculation, year 2 separate calculation we will have to do. But here, because year 1, 2, 3, 4 all will be same calculations only, considering everything is per annum. Everyone clear? So here I am basically doing 1 to 4 per annum. Okay, ready everybody? All right. So I'll write here particulars. I'll write here amount. Okay. Story number 1. Can I say in story number 1? Story number 1 means if I go for a new machine today, what will I get in these 4 years? Can I say I will get CFAT? Correct. I will get CFAT of rupees 80,000. I'll get CFAT of rupees 80,000 per annum minus story number 2. Can I say story number 2 is also going to give you CFAT? Story number 2 will give you CFAT of rupees 30,000. So, do you understand that incremental cash inflow will be 50,000? Everyone clear? Incremental CFAT basically is going to be rupees 50,000 per annum for the next 4 years. Am I clear? Hello, everyone following now what I am doing here? Can you tell me now what should I do in point number 3? Come on, just want to know if you are alert. Point number 3, what calculation should I do now? Yes, instead of saying salvage, you're absolutely right, but a better way of saying is now you have to check for year 4 only, because see what happens now. Everything depends on this table, project details. In this, according to the years that I have marked now in red, I am going to be making these points. You're understanding? So year 0 was there, 1 to 4 was there, and 4 was there. So can I say year 0 I have knocked off, year 1 to 4 I have knocked off, now year 4 I am knocking off. Everybody clear? If there would have been, let's say, year 1 only somewhere, then year 1 also separately I would have had to do. Everybody clear? So like that, now year 4 salvage. So I'll write here at end of year 4, again a CI. Now what are these points? I am calculating what you're there now. I am calculating incremental cash flows at end of year 0, at end of years 1 to 4, now at end of year 4. In that, students, what I will do is I will take this here and I will say at end of year 4, if I go for new machine, no, story number 1, I will get salvage of rupees 20,000. Okay, I'll get salvage of rupees 20,000. And if I would have gone for existing machine continuation, then that also would have given to me a salvage, I hope you remember, of only rupees 1,000. Everyone clear? Only rupees 1,000. So that means, can I say the incremental salvage that you will get at the end of year 4 is rupees 19,000. Story clear till here? Now what we will do is, now that we have incremental cash flows, now we will say point number 2, okay, or Roman point number B, basically point number B, and I will say here calculation of incremental NPV. Okay, calculation of incremental NPV. Okay, now see, this we had done, no? This only I am duplicating here. Okay. Okay, ready? Now I will say that, okay, in year 0, I want to take incremental initial investment, which according to point number 1 above can I say we had got, according to point 1, incremental outflow was rupees 85,000 net of everything. Everyone ready now? 85,000. That only 85,000 I am writing here, and that continues. Then for years 1 to 4, I will be taking incremental CFAT, which I calculated in point number 2 above. Point number 2 tells me incremental CFAT is rupees 50,000. So instead of taking 80, I will now be taking 50. Everyone clear? And then in the last year, I will be taking incremental salvage, which according to point number 3, incremental salvage, point number 3, here only we got 19,000 as the incremental salvage. So I'll write here 19,000. All clear? Now what we will do, we'll keep the discounting factors and start calculating the NPV here. So on the calci, this is 85,000. Just a minute. 85,000. Okay, now 50,000 into 3.17. Yeah, this is 158,500. 19,000 into 0.683. This is 12,977. And the final answer comes to, hold on, something wrong I have done. 158,500 plus 12,977 minus 85,000. Yeah, 86,477. Everybody clear? 86,477. And then what we will say, I hope you all understand, this is incremental NPV directly available now. And we will say, since incremental NPV is positive, existing machine should be replaced by new machine. Everyone's story clear? This is how we have to present it in exam. Now, by the way, you remember no, that number we had got earlier also, hello? Everyone understanding what I am saying? Long cut method also same number we had got, but long cut method, why am I saying long cut method? Because long cut method, now we are calculating NPV of story 1 separate, story 2 separate, and then doing, NPV. Here we are calculating the cash flows incremental first and doing NPV only once. Now right now this might look like a longer method, but please know that here method 1 looks very short because the cash flows are very simple, you're understanding? Otherwise imagine CFAT and all, you have to make big calculations, then it takes a lot of time to do both NPV separately. So students, with that I explained to you the concept of replacement decision. This I have taught you is not bond refunding. What I have taught you is replacement decision. Everyone clear? We need not write this in the notebooks, but in case you want to, then this, okay, I'll write here example on capital budgeting replacement decision. Okay, example on capital budgeting replacement decision. If you want, you can take a screenshot and write it down in the notebooks later. You're understanding? This is not a part of the syllabus as such. So take a photograph, please. By the way, sorry, it's a part of syllabus. I forgot to tell you. A new chapter has been added now. In a sense, advanced capital budgeting is there. In advanced capital budgeting, replacement decision is there. So when we will actually be doing that, I will be asking you to check this only. You're understanding? I will be asking you to see this. So it is better if you write it and keep in the notebooks. You are understanding? So in a sense, not now. Today you take photograph, write it later, it will save little bit time. Okay? So take a photograph, please. 5, 4, 3, 2, 1. I think something went behind my head also. This also you can take. 5, 4, 3, 2, 1. Project details. 5, 4, 3, 2, 1. 5, 4, 3, 2, 1. 5, 4, 3, 2, 1. 5, 4, 3, 2, 1. 5, 4, 3, 2, 1. 5, 4, 3, 2, 1. And 5, 4, 3, 1, 2, done. Okay, now I will now in the notebooks directly start the concept of bond refunding, in which I will be directly doing the calculation as per method number 2. Are you all there? But after few days you will not understand. I hope you are understanding. After few days it will go bouncer. That is why this example which I gave if it is there, it will be very good. Everyone clear? If it is there, it will be very good. Done. So how many sides we should leave for this? 2 sides are enough? 3 sides. 3 sides we can leave. You should, please. You should. I insist. Done. You write this down so that you will always remember exactly what happened. See, if method 1, you know what? Listen, I'll tell you some classic example. Classic Instagram doubt that people ask me on Instagram. They say, sir, listen to the doubt. Okay. How we got 85,000? We got 85,000 by doing 1 lakh minus 15. Remember, 1 lakh minus 15. How we got 19,000? We did 20,000 salvage of new minus 1,000 salvage of old, correct? Now, students ask me, especially those who have bunked lectures or who have taken somewhere else's notes, not my students, all those kinds of species are there, they ask me this doubt. Sir, if in year 0 we have already sold the old machine, then how are we selling it again? Understood question? So you see, I can't answer all this on Instagram. You're getting it now? Because I hope you realize you are not selling it twice. There are 2 stories. There are 2 stories merged in one story which appears as one NPV. There are 2 stories in the background, which many students and unfortunately even teachers don't understand. There are 2 stories in the background. I remember one full night I had to spend just to understand what exactly is the replacement decision before teaching. As a student, I don't know how I cleared, but as when I wanted to teach, I had to go into depth, because I'll tell you, in Inter CA, for 2 years I taught this chapter. After that, I started understanding what replacement is all about. After 2 years of teaching, it is when my brain started opening up about this. Otherwise, see, ICI solution, abracadabra and solution comes. Answer. But then in that you try to figure out logic and this and that, sometimes you misunderstand. Okay, this is exactly like that. Okay, and we tell students also agree. But as you teach more and more, you start developing little bit finer sensitivities towards a particular concept. Okay, why this, why that, etc. And it was then that I realized that in one NPV which is seen, there are actually 2 NPVs which are merged. You are understanding? And see, I made it very simple for you, because from start only I told you there are 2 stories, this and that. But direct answer comes, Story 1, story 2, all this language is not there in ICAI. Straight away answer comes. So it was for explaining replacement decisions that I invented this concept called as project details, arrows, year, this, that. All that was only for replacement. But then students liked it so much now that I did this project details for all capital budgeting questions in Inter-CA. You're understanding? Whatever normal question also now we used to make project details. Normal question, one story only used to be there, but it's okay. We used to make project details for everything. So that is why now method 1 writing is very important. Otherwise method 2 will appear like khichdi or pongal. You're understanding? It will appear like all mixed up like this. Method 1 is like, oh, rice separate, dal separate. You're understanding? Method 2 is yellow rice. You're understanding? Like that. So that's the whole situation. Now students, 3 sides I hope you have left, and now we will enter into what exactly is bond refunding. Okay. I will explain it to you through one question only. I'll tell you which question. (26). Everyone come to question number 26. Next week timetable you got, no? Or this week's timetable? We are together, no? Till Thursday. Okay. Read question 26. So reading question 26 is like watching Money Heist Spanish web series without English subtitles. What you are speaking, God knows. Huh? So professor only you require. So please pay attention. Ready? See. There is this company, ABC Limited. It has 300 million rupees. It has 300 million rupees, 12%. Just give me 1 minute. Huh? Okay, ready? All right. So ABC Limited has 300 million 12% bonds outstanding with 6 years remaining to maturity. Okay, let's understand this story first. I am company. Clear? My name is ABC Limited. In the past, I issued bonds, face value 300 million, coupon rate 12%. As of today, 6 more years are left for the bond to mature. Everybody clear? 6 more years are left for the bond to mature. Now, since interest rates are falling, ABC is contemplating of refunding these bonds with a 300 million issue of 6-year bonds carrying a coupon rate of 10%. Okay, this is where the story lies. What happened now? Let's say Bhavani is there, okay? I am ABC Limited. Few years back, I issued these 12% bonds, and let's say Bhavani was the one who purchased these bonds. Everyone ready? I am paying 12% as the coupon. I'm paying. As of today, 6 years are still pending for me to pay her interest, and after 6 years, I will repay her principal. Everybody clear? Now, what do you think I have done with Bhavani's money? Dream 11 team I have made? Huh? No. I took her money and I must have invested in some project, some asset, some full-fledged business must be going on. My whole plan is there. After 6 years, I will stop the business, get out the money and give it to Bhavani, correct? But today, no, I am feeling sad. Why? Because in the market, no, interest rates have fallen. Which means today, if I would have issued bond, no, I would have been able to issue it at a cost of capital of only 10%. But right now I am getting a cost of capital of 12%, ignoring tax right now. Everyone clear? KD, cost of debt. For me, right now the KD is 12%, I am paying 12%. But today if I would have been able to, issue new one, today if I would have gone, I would have been able to raise money at only 10% cost. Now, this is not some floating interest rate. I hope you are understanding, correct? This is not some floating interest rate. And therefore, do you know, if the interest rates fall in the market, the bonds that Bhavani is holding, the market price of those bonds will go up. I hope you remember. Market price of those bonds will go up because the 12% bonds will start trading at premium straight away. People will run behind these bonds, correct? Mathematically also you understand. Which means mathematically also you understand, meaning for someone like Bhavani, she will get her 12% return. But if she tells her friend Kusuma that, hey, I am getting 12%, you can come here, outside you are getting only 10, you come here. By the time Kusuma comes to this bond, the prices of this bond would have gone up so much that Kusuma will experience 10% only. I hope you remember this explanation. 1 hour is explaining this to you. Correct? And basically, because see, if Kusuma is also able to buy the bond at the price at which Bhavani was able to buy, then Kusuma will also get 12%. But like that, whole country will run behind this bond. Then you're understanding, the demand will take the bond price to such a level that this will also start giving exactly what outside people are getting. But that is basically the YTM part from the investor's point of view. This sum I'm not talking from investor's point of view. They are playing with market prices and all. That is a secondary market. I am talking of company primary market. For me, I to raised 300 million. I am giving 12%. Everybody, are you able to understand? For me, it's not changing, no. For me, I am still suffering a cost of 12%. Everybody clear? Market price, sir, went up. Kusuma is getting 10% only. That is all investor point of view. Everybody clear? For me, nothing to do with market price as of now. For me, I raised 300 million, I am giving 12% interest. Have you understood now? We are not talking from investor's point of view. Investor will get YTM of 10 only. Kusuma will get YTM of 10 only. She will not get YTM of 12. Bhavani is getting YTM of 12 because she purchased it at a time when the YTM must have been 12. The prices must have been low or she must have bought it at face value. Everybody clear? If she must have bought it at face value, and the redemption is also going to happen at face value, for someone like Bhavani, YTM and coupon rate will be same. But for someone like Kusuma, who will buy it not at face value, but she will buy it at a premium, can I say the YTM will be less than the coupon rate? Everybody, are you all able to understand? Clear, huh? If Kusuma would have been able to buy this bond at discount, can I say her YTM would have been more than 12%? Because 12% she's anyways getting, plus capital gain she will get. No? She's buying at discount, redemption at par. So, point is, I've been talking to you about this since long. When the issue price or the market price is face value only, redemption is also face value only, that means you are not getting any capital gain. The only gain you are getting is interest. Your YTM, your yield will be same as coupon rate. Correct? But all these discussion, students, irrelevant for this concept, because here I am not talking about you. You are understanding now? I am talking about me. Narcissist behavior. Me, I, me and mine. World revolves around me. I am the center of universe. Ready, everybody? So I am right now talking about myself. Listen carefully. I am, in a sense, I am ABC Limited in this particular company, in this particular example, and I am feeling sad now. Now I cannot call up Bhavani and say, Bhavani, from tomorrow now I will give you 10%. She will remove Bhavani Talwar, you are understanding? She will say, she'll come out with sword and say, what nonsense, 12% you had committed. It's a fixed interest. If it was, listen, if it was a floating interest bond, then this concept is void ab initio. You are understanding? Floating interest means, I will tell Bhavani, whatever is the market interest rate, I will give you. If that was the case, then this concept is not there. It's a fixed interest bond. So I am feeling very sad that I have to pay 12%, 12%, 12%. Ready, everyone? Okay. Now, let's say I have a financial advisor. Okay. Financial advisor comes to me. Let's say Mohammed is there. He comes to me and says, sir, why are you sad? I have got scheme. I say, what scheme you have? He says, sir, you give back Bhavani's money, no? Finish it off. Call the bond earlier. You understand? Bond call back, like buyback. You understand? Call it back. In ICAI language, refund the bond. Are you all there? Bond refunding. Refund it, sir. I'll say, but how can I refund? Her entire 300 million is there in a project. And the project is still going to run for 6 more years. I cannot withdraw money now. And I need money now for 6 more years. At least I will require 300 million. Mohammed says, sir, scheme now is like this. You go to the market today only and you issue another 300 million bond. I am telling him, no, I don't want 300 million more. I already have 600 million. What to do? He says, sir, you issue now. When you issue, you will be able to pay interest of only 10% now on that. Because new bond you are buying. Just a minute. Ready? New bond that you are buying, you are issuing, sorry. Can I say that will be at 10% only? I will say, that is okay. But then with me there will be 600 million, no? Then Mohammed says, no, sir. Imagine that Mahalakshmi is going to buy these new bonds at 10%. 300 million Mahalakshmi will pay. New investor, correct? Sir, take the money that Mahalakshmi will give and give it to Bhavani. Game over. Which means the 300 million which is there in your project will now be considered to be Mahalakshmi's money. I hope you are understanding. Hey, understood what I am trying to explain? Change the investor. Replace the investor only. Bhavani will get her money back, and you will now be able to continue in life, everything normal, but the interest rate falls from 12 to 10 now for you now. Everybody clear? Say, what an idea, Sirji. Students, however, can I say, if I go for this new bond, listen to me very carefully, huh? If I go for this new bond, can I say for 6 more years I'll have to pay interest at the rate 10%, 10%, 10%, 10%, 10%. These all will be cash outflows for me. Everybody clear? Outflow, 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 outflow. I want us to mentally calculate present value of all these cash outflows. Everybody clear? Present value of all these cash outflows. Okay. Let's say it comes to X. Everyone clear? So what is X? Let me repeat. If I issue new bond to Mahalakshmi, take her money and pay off Bhavani, and then continue paying Mahalakshmi at the rate 10% per annum for 6 years, and give her back her money after 6 years, all these future cash flows which are there now are all cash outflows only mostly. You're understanding? Find the present value of all these net cash outflows. Let's say it is X. Ready? Now what this concept is saying, listen carefully. This concept is saying, wait, don't listen to Muhammad, wait. I say, why I should not listen? He's talking sense, no? He's saying, no, wait. Just as you calculated X, you also calculate Y. I'll say, what is Y? Why to calculate Y? I'll say, okay, what is Y? This concept is saying, calculate the present value of all your cash outflows in a scenario where Muhammad wouldn't have come only in your life. In a scenario where you wouldn't have felt sad about your existence. In a scenario where you would have continued with Bhavani's bond. I hope you are able to understand. Correct? You would have continued to pay 12%, 12%, 12%. Calculate na, the present value of that also. And let's say the present value of those cash outflows, if I would have continued with Bhavani, story number 2 basically, if I would have continued with Bhavani, the present value of those cash outflows is, let's say, Y. Can I say the present value of going for Mahalakshmi instead of Bhavani is, can I say, X? And these are all cash outflows. Remember, these are not NPVs. These are cash outflows present value. Can I say if X is less than Y, we should refund the bond? I hope you are able to understand. Which means if the cash outflows in case of going for Mahalakshmi, X, present value of all those cash outflows is less than continuing with Bhavani's bond, then you should replace. Now, why should you continue Bhavani's bond? But what if Y is less than X? Then you should not go replace, continue with Bhavani's bond. But then a question will come in your head. How can Y be less than X? Correct? One question can come. How can Y be less than X, sir? X only will be less than Y because Mahalakshmi is charging you only 10% cash outflow. Bhavani was charging you premium 12%, correct? So, of course, sir, the cash flows, you are understanding the concept, na? Of course, there is nothing to think only, sir. Story number 2, that is continue with Bhavani's bond, is a useless story, sir. It is anyways going to be expensive than going for Mahalakshmi. Correct? Everyone, are you understanding what I am saying? This concept is saying, no, don't think like that. I'll say why. Then this concept is saying, yes, going for Mahalakshmi will help you save 2%, that is there. But in going for Mahalakshmi, can I say you have to refund Bhavani midway? If you have to refund Bhavani midway, can I say she will not be happy with just the redemption value? She will want the market value, or she might want more premium because I'm calling her bond midway. There could be a premium on callback that I have to pay extra just for refunding her money before time. I hope you are able to understand. Just for, there could be some transaction costs in doing this entire transaction. You understand, you have to take everything into consideration. These costs, can I say, wouldn't have been there if you would have incurred, you would have continued with the Bhavani bond. Am I making sense? You're understanding what I'm saying? When I issue a new bond to Mahalakshmi, I could be incurring, as Intercia taught us, flotation costs. You remember all this concept? Flotation cost means initial expenses, initial preliminary expenses at the time of cost. Accounts, we call it as cost of issue of debentures. It's a deferred revenue expenditure kind of, fictitious asset which gets amortized over the life of the bond. You might have heard about all that. Initial expenses of the cost of issue. You're understanding? Now someone has told me on chat box, sir, listening to all this, it appears that going for Bhavani, continuing with Bhavani is better. That's also not the case now, because see, all these costs you are incurring, but at the same time, can I say, Mahalakshmi is helping you save 2%. The point I'm trying to say is you have to calculate present value of both stories and find the incremental. You're understanding now? It is basically, if you think carefully, it's a bond. ICEI calls it as refunding. It should have called it as bond replacement decision. I hope you're understanding. It is capital budgeting connection. No, it is replacing. Just as there you are replacing a machine with another machine, here you are replacing a bond with another bond. If incremental NPV is positive, only then we should replace. Simple calculation. Full understood? Okay. All right. So students, the lines which I have underlined, no? Acha, before that, let me just see if I have. Hey, were you able to see anything here? Bond convexity video you all were able to see, or still not seen? Okay, thank you. I don't know where this is. Read my notes. I have written some paragraph. Read it, see if it makes sense. Making sense? Okay. So copy this. Hey, after leaving 3 sides, huh? After leaving 3 sides. Okay. Okay. Now I would request you to read the underlined part of the question once more. Everyone, please. Underlined part of the question. Understood story? Okay. Now let's read ahead. They are saying issue cost of the new bond will be 6 million. My God. Which means just to issue this new bond to Mahalakshmi, all the advertisement, all the SEBI charges, legal, this, that, underwriting commission, all that will cost you 6 million. One shot payment today, which in inter we used to call as flotation cost. Everybody clear? This is your flotation cost. Also, call premium is 4%. Another headache. Call premium. What do you think is call premium here? When I call back bonds from Bhavani, no, I have to not only pay 300 million, I have to pay 4% extra as a premium on the call. Everybody clear? So these two, can I say, are additional costs in for replacing. Now, 9 million being the unamortized portion of issue cost of old bonds can be written off no sooner the own bonds are called off. Ignore this line right now, you will not understand. You will understand maybe 10 minutes from here, okay? Marginal tax rate is 30%. You are required to analyze the bond refunding decision. So students, my request is don't write now, because now I will write something here, then I will go down, then again go there, change things like that. So wait till the whole solution settles and then start copying, okay? Question number 26. Okay. So I am writing here question number 26. And I will give heading bond details. Now, in bond details, what will I write? Story 1. If new bond is issued, that means existing bond is refunded today. Language is clear? Story 2. If existing bond is continued. Correct? Left story Mahalakshmi, right story Bhavani. Everyone clear? Okay. Now, what could be the project details of story number 1? Do you realize issue of new bond will give you inflow? Refund of existing bond including call premium will result in outflow. Interest which I will pay to Mahalakshmi at the rate 10%. Everybody clear? Interest at the rate 10% will be an outflow. Then can I say redemption of new bond will be outflow. What redemption? After 6 years I have to give back, no, Mahalakshmi her money. Everyone clear? 300 million I have to give back. Hey, if story 2 is continued, yeah, I'm sorry, one more thing I forgot here. One more thing I forgot. There is going to be a flotation cost. Wow, very good. You remember, no, flotation cost. Hello. New bond, if I am issuing, then I have to incur, no, issue price, issue cost. Correct? Everyone done? Great. Now, story number 2. In story number 2, no, nothing is there. Only interest I have to pay at the rate 12%. Outflow. And I hope you realize redemption of existing bond here also I will have to do. I hope you are getting it, huh? Hello. Alright. Let's see how many of you are smart. These cash flows are irrelevant. Because do you realize story 1 or story 2, my outflow is going to be 300 only. In incremental it will net off. Everyone clear? In incremental it will net off. Great. Right now I am going to put the years: issue of new bond, refund of existing bond, flotation cost. Let's see if you understand. Interest, redemption. Everyone clear? Interest, redemption. Done. Now, common things. Can I say both story will have a life of 6 years? Tax rate given in both stories is, for both stories is 30%. Now, something to do with cost of capital. Now, cost of capital, can I say, is the discounting rate. Now, in this, no, if you notice the question is silent about cost of capital. At what rate you should calculate NPV is not given only. So, ICAI is saying very simple. Can I say the current rate is 10%? No. Are you all there? Current interest rate is 10%. Tax rate is 30%. Cost of capital will be KD, that is interest rate into 1 minus T. 10% into 1 minus 0.3, which is equal to 7%. This formula I hope you remember from inter-CA. All clear? Now in this entire cash flows now which I have written here, I have ignored one thing: taxation effects. Okay, now what do I mean by taxation effects? I will tell you when I tell you taxation effects. Right now ignore. Everyone clear? We'll talk about it later. Just to give you a slight example. Students, I am paying interest now, but I will save tax also now because of paying interest. Just I am giving you hint. Everybody clear? We will talk about all those taxation effects also in some time. Right now main cash flows now we'll try to knock off. Okay. So, you remember now I want to do incremental NPV, but for that I will be using method 2 of the last of the example I gave you. Method 2 means we'll first complete calculation of all incremental cash flows, and then one shot we will do the NPV at the end. Okay. All right. So, point number A: calculation of incremental cash flows. Now, if you notice, can I say I will again break the whole thing into 3 parts. Something at year 0 is there, something for 1 to 6 is there, and something at the end of 6th year is there. Everybody clear? So 3 parts we will break it up. So, I will write here point number 1. At end of year 0. Now, I am writing here particulars and amount. Can I say first of all I will write about story number 1. Everyone ready? Story 1, or maybe as I had done last time, story 1. So, you remember na, incremental means story 1 minus story 2. Everybody clear na? Story 1 minus story 2. Okay, in story 1 what is happening? issue of new bond is happening, issue of new bond. Okay, so I'll write here issue of new bond. Hey, when I issue new bond to Mahalakshmi, can I say I will get 300 million? And this 300 million, do you realize, is a CI? Everyone clear? It's a cash inflow for me. Then what is happening? Refund of old bond. Everyone clear? Refund of old bond. Refund of old bond year 0. Hello. Hey, I hope you people remember year 0, no? Year 0 generally we show the outflows as positive and inflows as negative, and we get final outflow. You understand what I'm trying to say? But still, it's okay if we do it like this also. Okay, issue of new bond 300 million. I will say minus refunding. Okay, minus refunding of existing bond. Everyone ready? Refunding of existing bond. How much are you refunding? 300 million? No. 300 plus 4%. Everybody clear na? 300 plus 4%. Now I have to give our call premium also. So 300 plus 4%, and that comes to how much? 312? Okay. So 312 million I have to refund, and this, do you realize, is a cash outflow for me. Everyone following? Cash outflow for me. Next, so I have done with this, I am done with this. I have to also incur flotation cost. I have to also incur flotation cost. So tell me, I'll do here minus flotation cost. How much is the flotation cost I have to incur? Issue cost 6 million, correct? So I'll write here 6 million, correct? And that, do you realize, will give you 18, no? Just check. 18 million negative. Okay. So negative 18 million. Done. Students, I hope you realize this is incremental cash inflow, because I have taken inflows as positive and outflows as negative. Everyone there now? I have taken inflow as negative, inflow as positive, outflow as negative. So there is an incremental cash inflow of negative 18, which means it's an incremental cash outflow. Everybody, are you able to understand? You have to be very clear on what you are doing. There is a negative incremental inflow, which means there is a positive incremental outflow. Everyone clear? Done? Okay. Then I will do minus story number 2. Everyone ready? Story number 2. Now in story number 2, do you realize there is nothing? Because nothing is there na here. Can you see? Story number 2, here 0 is nothing. So can I therefore say that incremental cash inflow is negative 18 million, that is incremental cash outflow is 18 million. Till your story clear? Incremental cash outflow 18 million. This is happening at end of year 0. Now we will go to end of years 1 to 6. Everyone clear? End of years 1 to 6. So I'll write here point number 2. At end of years 1 to 6 per annum, particulars and amount. Story number 1. Hey, in story 1, can I say for 6 years I'm going to be paying interest? I'm going to be paying interest. So I'll write here interest. On new bond, can I say will be 300 million into 10%, which is equal to 30 million per annum, minus story number 2, interest on existing bond, 300 million into 12%, that is 36 million. Everyone clear? 36 million. Now if you notice this, hold on, this is a cash outflow, this is a cash outflow. So do you realize incremental cash outflow, correct? Incremental cash outflow is negative 6 million. That is incremental cash inflow is 6 million. Come on everyone. Negative outflow is there, which is basically an inflow. Why is there inflow? Obviously, in fact, it is for this benefit that we are refunding. Everybody clear? It is for this benefit that we are refunding, that we are going to be saving interest every year. Everyone clear till here? 6 million interest every year you will save. No, 2% of 300 million is 6%. You will save every year. Got clarity? Okay, done. Yes, it's a saving in outflow, correct? Understood, na? Saving in outflow. Done? Okay. So, what happens is, to save this 6 million per annum, I have to basically incur net 18 million rupee cost. You understood? I have to net incur it. You will say, sir, but 6 is less than 18. 6 is per annum. Hello, everybody ready? And this 18 is one short payment. Everyone following till here? Okay. And like that, there is going to be end of year 3, end of year 6, correct? End of year 6. This is done, this is done. Now what is left is end of year 6, but I hope you realize end of year 6 is useless calculation, but still I will show it to you, okay? So I will write here point number 3. Just 1 minute. Okay, ready? You might be thinking what I am doing middle, no? I am just getting a little funny feeling on the pen. That is why I am just trying to see if it's proper. Anyways, so point number 3. At end of year 6, particulars amount. Story number 1. Redemption of new bond. Cash outflow for us is 300 million. I will redeem na new bond. Mahalakshmi, I will give 300 million back. Minus story number 2. Redemption of existing bond, 300 million. Do you all understand what I am doing here? Clear? And this, do you realize, will give you incremental outflow dash irrelevant. Na? Entire thing is irrelevant. Everyone clear? There is no, in a sense, whether I should replace the bond or not, for that this cash flow is not going to be having any say. Everyone clear? Because it is saying whether you continue with Bhavani or you go with Mahalakshmi, 300 million you have to pay only. No, so that part is irrelevant. Everyone following till here? Clear? Okay. Now tell me what to do. Now we will go to NPV. Everybody clear? We will now go to NPV. So I will write here point number B. Rajarshi, yes. Point number B. Calculation of incremental NPV. Everyone ready? Calculation of incremental NPV. Year, particulars, calculation, cash flow, discounting factor at the rate 7%, present value. Hey, can I say there is a 0? There is a 1 to 6 and there is a 6. In year 0, I will say incremental initial investment according to point number 1 above is negative 18 lakhs. Everyone clear till here? Hello? I'm sorry, 18 million. Incremental cash outflow 18 million. So I will in fact write it like this. This is 18 million. Everyone clear? 1 to 6, can I say there is a savings in interest according to point number 2 of 6 million per annum. Everyone clear? Sure, everybody understood? And then 6th year, not interested. Everybody clear, no? Even if I write now, 0 is there. So then what should we do? We should then say 1 divided by 1 divided by 1.07, 1, 2, 3, 4, 5, 6. And this is GT. 4.767, this is 1, and you get incremental NPV at the rate 7%. This is 18. 6 into 4.767 is 28.602 minus 18, 10.602 million. Since incremental NPV is positive, existing bond should be refunded. Everybody clear? And replaced with new bond. Story understood? Everything clear? Okay. But this is not the solution. One point we have skipped throughout. What point we have skipped? We have skipped the point of tax. Now I will introduce tax, but without tax you understood everything, no? Without tax this is like the base answer. You understand? Tax is like, you're putting cheese. Main pizza you understood, no? Okay. Now let us discuss what all tax impacts will be there. This is going to be slightly complicated and I would request your full attention. All the best to me. See, first of all, you have to think, you people know more tax than me. I am not joking. I only pay tax. You're understanding? You are the ones who are studying. I don't remember anything about tax. That is why I have to hire a CA. Okay? Even though I am CA. Wow. Doctor going to doctor. So, please understand, you people know more. Take your time and I am going to be marking one by one. You have to keep telling me, is there going to be tax impact there or no tax impact? Everybody clear to think? Okay. First point, only this cash flow. I am issuing new bond. 300 million is what I issued the bond for and I got 300 million from Mahalakshmi. Tell me, on this 300 million, is there going to be any taxation effect? Yes or no on the chat box. On this 300 million. Correct. No. Everybody clear? Nothing is there. It's a capital revenue, capital inflow. Money comes in and I'm going to invest it, correct? Or I'm going to refund the money, whatever. Great. Forget it. Point number 2. Mahalakshmi, I am refunding her bond. Mahalakshmi, I am refunding her bond 300 and what 42, no? How much we refunded? 312, sorry. 312 million we refunded, correct? 300 plus 4%. 312 million we refunded. Take your time and tell me, on this 312 million that we are refunding, is there going to be any tax impact? Take your time. Yes or no? 312 million that we are refunding, is there going to be any tax impact? Take your time. Acha, by the way, before you take your time, do you understand any kind of inflow I am asking? No. Inflow. Listen now. If when I asked you about the first thing, they have to think, oh, it's an inflow. Your question should be, is it taxable revenue? Your understanding, should we be paying tax on it? Is that what you have to think? And when I'm asking you about outflow, you have to think, oh, is there some allowable expense on which I'm going to be saving tax? Everyone clear, no? So when I'm asking about tax impact, on inflows I am asking, will you be paying tax on it? On outflows I am asking, will you be able to save tax on it? Everyone clear story? Now tell me, for the second case, 312 million I am paying. Is there going to be any tax impact or tax saving because of this outflow that I am going to be doing? Take your time and tell me yes or no. Yes, there will be a tax savings, not on 300, but on the revenue expenditure of 12 million. Everybody, are you all able to understand? 12 million revenue expenditure, na, that premium I am paying on the call. That expenditure, on that I will be able to save tax. Correct? Now you use your brains, if any, and tell me the tax that this 12 million will help me save, that should be amortized over 6 years, or should I recognize the whole tax saving today only? Understood question? See, look at me. 312 million you are paying today. Out of that 12 million also you are paying today only. On the 12 million that you are paying, our taxation is saying no problem, this is a revenue proper legit cost, you will save tax on this. Now I am asking you, the tax that you will be saving on that 12 million, will you recognize that entire tax you are saving ASAP today only, or would you be wanting to amortize it over 6 years is the question. Today or amortize? Everyone please participate. Today or amortized? Adarsh, can you give me logic of why you wrote this? Or you just wrote? Because apart from you, everyone else is saying amortize. Adarsh is the only one who is saying, no sir, claim it today only. Adarsh is saying, sir, because the entire loss is happening today only. No, but that is not the logic for amortization. Na, MC, like for example, depreciation is also another case of amortization. I buy the fixed asset today only, entire money I pay today only. If this logic is there, then why am I not showing the entire fixed asset recognizing in P&L today only? I am amortizing, no? So tell me, why should I show it today only? Students, what is your answer? Today or amortize? Okay. You are wrong when you say amortize. When you say amortize, you have to understand what is the concept of amortization. It is matching concept. Accounts. Matching concept means that, okay, this cost I have incurred today, but because the benefit of the cost I will be receiving over 5 years, it is for this reason I cannot show the entire cost as a cost in year 1 only, because matching concept principle gets affected. Everybody, are you able to understand? And then what matching concept says that you are going to be getting benefit for 5 years, no? Then that cost also you recognize over 5 years. That is the concept of amortization. Do you all agree what I am trying to explain? Hello? Depreciation is same concept. I buy a machine will last for 5 years, then the entire cost of the machine I cannot put in P&L. Because P&L is saying that on my credit side the sales is there, 5 years na sales will be happening because of this machine. How then are you putting pressure only on year 1? You should amortize it over 5 years. That is called as depreciation. Advertisement expenditure, you see, you have heard of this classic example, deferred revenue cost. You do an advertisement of 2 crore rupees in television or here and there, YouTubers and all. That advertisement that you do, 2 crore, you will not be getting the benefit of that advertisement only for year 1, no, you will get it for over next, let's say 3 years, for example. Let's say you have put a big hoarding you have put. The cost of your hoarding is 1 crore, big places, everywhere across Bangalore you have put hoardings. But the benefits of those hoardings you will be receiving for the next 10 years, for example. So then the cost that you have incurred in that hoarding is not a revenue expenditure, it is a deferred revenue expenditure. Everybody, are you all there? Why? Because that particular expenditure that you are incurring is going to give you benefits over 10 years. So matching concept says cost and benefit timing should be matched. So if benefit is over 10 years, your cost is incurred today only, that doesn't mean you will show the cost today only. You will show it over 10 years. That is the concept of amortization. Everybody clear? See, if now let's say I am paying salary to my staff. Now salary I am paying to my staff will give me benefit in that year only. You are understanding? That is why salary entirely I am showing in P&L in that same very year. I am not amortizing salary. But advertisement cost I will amortize. Machine purchased cost I will amortize in the form of depreciation. That is the concept of amortization. Till you are clear? Matching concept tells you for whatever period that particular cost will give you a benefit, for that much period you should amortize. Now, can I say in this particular case, the 12 million that you are paying, everyone listen, the 12 million that you are paying, do you realize you are paying not to create an asset for 6 years, but to end an asset which was existing? I hope you are able to understand. The 6 million that you are paying is not going to be giving you some kind of benefit over 6 years. That what benefit will get Bhavani, you are refunding back. I hope you are understanding. She is not there only to give benefit. Come on, everybody, are you able to understand? And therefore, the 12 million that you are paying is not some deferred revenue which I will defer over the life. There is no life. The life of the bond ended. I hope you are getting it. It is because of that reason the entire 12 million tax savings I will recognize in this only. Everybody clear? Look at me. Look at me. I am talking amortization purely from taxation perspective. 12 million cash outflow is happening today only. Hello. The CO of 12 million I am showing today only. It is already shown in year 0. This 312 million outflow I have already shown. I am not telling you that we will pay 12 million in 6 years. No. 12 million we are paying today only. I hope you are understanding. And now I am saying the tax that you are going to be saving on that 12 million also will be shown one shot today only. Everybody clear? You tell me one thing. Why does tax saving happen? Because we make accounts, in that P&L is there, government says whatever is your profit, on that you should apply tax. Now, if that 12 million in my books of accounts or in my taxation books of accounts, I would have spread as 2 million, 2 million, 2 million, 2 million, 2 million, then can I say taxation benefits also I would have got on 2 million per annum for 6 years? I hope you are able to understand, because of books of accounts. But now I am saying no, don't amortize it as 2 in your books. In your books also you should show one shot 12. Everybody, are you all able to understand? Hello? In your books also you will show one shot 12. And if you are in your books of accounts one shot 12 you are showing as a cost, can I say the entire benefit you get because of this allowable expenditure, you will get today only, no? You don't need to wait for 6 years. Everyone clear? Unlike purchase of machine, if I purchase a machine, can I say the tax benefit I will get because of purchasing machine, I don't get in the year of purchasing machine, I get throughout the depreciation life period, no? Depreciation helps me save tax. What is the tax? What is depreciation? Depreciation is nothing but I am telling government I incurred some cost for purchasing the machine, give me some allowance, no? Government is saying no problem, you show it every year little. That is called as depreciation. So in case of a machine, can I say my others for you, my cash outflow for buying the machine will happen today only. But in my books of accounts, I will recognize that outflow over a period of time. And because I will recognize that over a period of time, taxation also I will get benefits over a period of time. Everyone clear? Hello, you're following, no? Everyone clear? Sure? Okay. Like that. So therefore, I will come back here and I will pull this whole thing down and I will write here tax saved by call premium. Hey, a tax saving, can I say, will be considered as an inflow. Everybody, are you all there? A tax saving will be considered as an inflow, and that, do you realize, will also happen at end of year 0 only. I am not going to, if it was to be amortized, no, I would have written like this. Please check, everyone. If it would have been amortized, I would have written it like this. The premium is being paid today only, but the tax I would have got over 6 years. Correct? But here I will write 0. Now, one thing I want to tell you, listen to this explanation. 12 million is the premium, 30% is the tax. Can I say 3.6 million you will save because of this 12 million expenditure, correct? If you would have done amortization, no, then can I say 2 million every year you would have shown expenditure. On 2 million every year, 30% you would have saved. Like that, can I say you would have saved for 6 years? I hope you are understanding. Do you realize this also comes to 3.6 only? End of the day, your tax being saved is 3.6 only on 12 million. Then you will say, then sir, if either ways it is same, why are you creating so much fuss? Because time value of money will get affected. No, I hope you are understanding. I will not be able to write into 6. This will be into the annuity factor of 6 years. Everyone clear when I calculate present value? And this, I hope you realize, is into 1 only. Everyone clear, no? See, if time value of money is to be ignored, then this whole discussion is irrelevant actually. Show now 3.6 million, you show wherever you want. What difference does it make? But because of time value of money, can I say here the cash flow, the saving will be slightly less because of time value of money, because you are getting these benefits in delayed form, no? So in present value, the number will be slightly less, like that. Understood? Huh? Okay, thank you. So I'll remove this. Now, where should I incorporate? Others coming, wait. Where should I incorporate this tax saved by call premium? In year 0, everyone ready? In year 0, what I will do is, I will take this, pull this down slightly. Year 0, everything normal. I am just taking this 1 notch down. And I am saying that if I go for story number 1, correct, 100% I will issue new bond from Mahalakshmi. I will get 300 million. I will repay Bhavani 312 million. But when I pay that 312, can I say I will also be getting tax saved by call premium? That will be 12 million into 0.3, 3.6 million inflow. Everybody clear? 3.6 million inflow. All done. So this, I'll just take it here. This I will write CI. This is of course CO. So 3.6 will get added, no? So 18, 15, 14.4, na? This will become, someone just confirm, 14.4. Clear? This therefore will become 14.4, 14.4, and this 10.602 plus 3.6, this is 14.202. 3.6 will get added, na? Simple. 14.202. All done. So we have taken into consideration one taxation effect. Congratulations. Okay. Okay. In fact, okay, you are able to see the font, na? Color. Okay. Just doing little drama here. Wherever tax effect is there, na, there I am just putting a little color different. Okay. All right. Now, students, this we discussed. You remember, na, what discussion is going on? Is there going to be any tax effect? Remember, na, that question? Now, is there going to be a tax effect? It's a payment. It's a payment. Which means the question I am wanting to ask you is, will there be some tax saved by this flotation cost? Flotation cost. Will there be some tax saved by the flotation cost? Yes. Correct? Flotation cost, how much are you incurring? 6 million flotation cost you are incurring. By the way, I would like to make things little more clear for you. This is flotation cost on new bond issue. Everyone clear? On issue of new bond. My question to you is 6 million. 6 million you are incurring. On that 30% you are saving, which means, can I say 0.18 million tax you will save. Take your time, think about all that I told you about amortization and this and that. Take your time. There is a purpose, I made it very clear here. Think and tell me that this 6 million that you are incurring to issue a new bond, what do you think accounts and taxation will talk to you about the recognition of this 6 million? Sorry, this is 1.8. Correct. What do you think accounts and tax will talk about the recognition of this 6 million? Will they tell you show one shot in first year P&L only, like that they will show? Or do you think they will say, no, you need to amortize it over 6 years? What do you think they will tell you? Yes. Do you realize they will amortize it? Why amortize? Because the flotation cost that you are incurring, can I say, is giving you a benefit for 6 years? No, Mahalakshmi is going to be there here with that bond for 6 years. For that bond, we had to incur this preliminary expense. This is a preliminary expense. You must have heard this. This falls in balance sheet asset side till the time it is completely amortized. Hello, everyone remembers, na? deferred revenue expenditure accounts you have done, no? So do you therefore understand that this, listen, 6 million that we are paying, that I am showing in year 0 only, I am not changing that 6 million. I am saying the tax that this 6 million will save, do you realize will be saved for all years, for 6 years. Everybody clear till here? So what we have to do? We have to simply divide by 6, correct? Okay. So what I will do is, I will have to pull this down further. And I will say tax saved by flotation cost of new bond inflow. Can I say 1 to 6? Everyone clear? 1 to 6? Others? Ready? 1 to, everyone clear till here? Okay. Now, like that now, if you know, then slab rates also you should take into consideration. Then taxation, depreciation should be exactly according to what they are saying. So those little bit finer details about what they are exactly saying will ignore. Huh? That much little leeway you give to finance, please. Okay, and this all done. 6 years you will be getting tax savings. Any doubts till here? No, no? Very good. Now doubts will come. Listen very carefully, please. This is going to be tough, huh? I hope we all understand this. It will happen smooth. What is the time now? 8:21. From here till maybe 8:40, I am going to be speaking on tax only. So please be alert. And I would be happy if those whose videos are on, you nod your heads, and those whose videos are off, you please give me yes, no, something on the chat box. I need some kind of participation here, okay? Otherwise, I will lose my footing. The earth beneath my feet will start shifting. The skies above my head will start shattering. Please reply. Do you understand that when the existing bond must have been issued to Bhavani few years back, at that time also I must have done some flotation cost? At that time, many years back. That flotation cost as a cash outflow must have been shown in that year only. The flotation cost outflow, correct? It is sunk cost for me today. Everyone clear now? For today it is sunk cost. Everyone agreeing? Will that flotation cost also save tax for me? Yes. Can I say that flotation cost which I must have incurred when I must have issued the bond to Bhavani many years ago, the tax on that flotation cost must be amortized over the life of Bhavani bond? Are you all understanding therefore that if I continue story number 2, there will be a tax saved by flotation cost for the next 6 years also. Take your time. Tell me, are you able to understand? I am talking about which flotation cost? Not this 6 million. I don't even know what that flotation cost is. I am just telling you that when I must have issued to Bhavani, at that time I must have incurred some flotation cost. Imagine, no students, 4 years back I had issued the bond to Bhavani. And the total life of the bond is 10 years. Do you understand? Today 4 years have happened. 6 years are pending. My question to you is, 4 years back I must have issued, flotation cost I must have incurred. ICA and companies, income tax act, everyone told me that flotation cost that you are incurring, no, that flotation cost is giving you a benefit for 10 more years, and hence you should amortize it over 10 years. I said okay. I started amortizing for 10 years. Then 4 years happened. Now students, if I continue Bhavani's bond, I hope you are having the brain cells to understand that these remaining 6 years that we have with Bhavani bond, can I say my tax savings will continue, no, for 6 years? Come on everyone, are you all able to understand? My tax savings will continue. So what I will do is, listen to this carefully. Okay. Bhavani, thank you. Okay. So listen to this. I'm simply saying that there will be a tax savings on flotation cost of existing bond also. Is it palatable to all of you? You are able to understand what I am saying? Clear? Students, do you understand that now I have to calculate incremental tax savings? Come on. I have to calculate incremental tax savings. It will go into NPV, no? Everyone clear when it comes to NPV? Am I making sense? Hello? Done? Story 1 minus story 2, simple. So what I will do is, I will go down here, and we had written, no, end of years 1 to 6. This end of years 1 to 6, no, let us restrict it to interest only. We will not disturb this. And I will do again at end of years 1 to 6 for the tax saving part. Everybody clear? For the tax saving part. So I will pull this thing down. I will write here point number 3, at end of years 1 to 6, tax savings on amortized flotation cost. Okay, I'll write here particulars and I'll write here amount. Everyone ready? I'll write particulars and I'll write amount. In particulars, I'll write, if I go for a new bond, no, then there will be tax saved by flotation cost of new bond. Students, the flotation cost I am incurring for new bond is 6 million. Correct? This 6 million I am going to amortize. Please don't lose focus, otherwise it will become difficult for me. Everyone ready? The flotation cost I am incurring is 6 million. This 6 million I will amortize over 6 years, which means every year I will be able to recognize 1 million, 1 million, 1 million, 1 million. On that 1 million, can I say 30%, 0.3 million I will be able to save. Everyone clear till here? 0.3 million I will be able to save. This, students, is a cash inflow for me. Savings in outflow, no? Savings in tax is a cash inflow. And then I will say minus, sir, if I would have continued old bond, no, then also I would have got tax savings. tax saved by flotation cost of existing bond. Correct? And students, don't read the question. I read something there. You don't read right now. Huh? This amount given to you is 9 million. Are you listening? This amount given to you is 9 million. I will read the question in some time. Just trust me on this. Right now they have given to you 9 million. Everyone clear? So can you tell me how much is that, please? I'll do it. 9 divided by 6 into 0.3. 0.45. Everyone clear? 0.45. So I'll write here negative 0.45 million, which means there is an incremental CI of 0.15 million. That is incremental CO of 0.15 million. Everyone there? Now, what is this outflow all about? I'm not understanding, sir. Okay. I am saying if I go for new bond, no, every year I'll be able to save 0.3 million tax because of the flotation cost. But sir, if you would have continued with Bhavani bond, no, you would have saved 0.45 million every year tax. Oh, that means by replacing, I'm losing tax of 0.15 million every year. Everybody, are you able to understand? I'm losing tax of 0.15 million every year. Correct? Great. I will take this 0.15 million outflow. I'll go to NPV and I will say that in years 1 to 6, look at how I am presenting it. There is a loss in tax savings on flotation cost, or I might use the word on amortized flotation cost. According to point number 3, I am going to be losing 0.15 million every year. Everybody clear? I am going to be losing 0.15 million every year into 4.767. So this is 0.15 into 4.767, and this comes to negative 0.715 million. Okay, and that will therefore hamper your NPV by 0.715 million. So this is 14.202 minus 0.715, and that comes to 13.487. Everyone clear with this? 13.487. Done? Okay. Story is not over, huh? Now, if you understand this next thing, then I'll consider myself fortunate. Students, as of today, on Bhavani bonds, can I say 9 million flotation cost is yet to be amortized? Are you able to understand? Okay. If I continue Bhavani bond, can I say that 9 million will spread over 6 years and I will get my tax savings? I hope you understand the next thing. If I go for Mahalakshmi bond, do you realize that the unamortized flotation cost of Bhavani bond of 9 million, the entire tax saving I will recognize today only. See, take your calci, everyone, take 9 on calci, 9, and multiply by 30%. 2.7 you are getting. Done. Now look at me and nod your head or give yes on the chat box. Can I say as of today on Bhavani bond, you are still entitled for 2.7 million tax savings? Do you agree with me till here? If Bhavani bond is to be continued, this 2.7, can I say I will spread over 6 years and I will get 0.45 million every year. You are able to understand? Do 2.7 divided by 6. Do it once. 2.7 divided by 6. This is 0.45, no? Just check once. Correct? This is at this point. That if Bhavani bond is to be continued, then sir, that 2.7 tax savings which I am entitled to because of the flotation cost I incurred 4 years back, can I say, when I incurred that flotation cost, the government did not allow me to take entire tax savings. They said, sir, you amortize over 10 years. I started amortizing, 4 years amortization happened. As of now, sir, 9 million of flotation cost is yet to be amortized. On 9 million, 30%, sir, 2.7 million tax savings I am yet to get. Everybody clear? This 2.7 tax savings I will get, sir. If I continue Bhavani bond, no, I will get it as 0.45 million per annum for the next 6 years. Story clear till here? I want to ask you, now you are abruptly closing Bhavani bond midway, correct? In story number 1. Now I am not talking of story 2. I am talking story 1. In story 1, you are abruptly cutting off Bhavani bond midway. Can I say that 2.7 million tax saving that you are entitled to need not be amortized over 6 years? You will get it one shot today only, no, now, because the benefit ceases to exist. The bond, life is only not there of the bond. How will you amortize? Everyone clear? So that 2.7, one shot you will recognize, you will realize, can I say in story number 1. Everyone, are you able to understand? One shot you will recognize in story number 1 of the existing bond. So what I will do is, now I want you to see for yourself to understand this better. See how I am doing it. Huh? Don't see here and there. I am literally picking this up. Look at this. I am literally picking this up. Tax saved by flotation cost of existing bond. I am duplicating it. I am bringing it here and I am saying, hey, you will get it here also. I hope you are understanding. The only difference is here now you will get it at end of year 0. Come on everyone. Here you will get it at end of year 0. Maybe. Now I want you to understand one thing. If time value of money is to be ignored, then this and this is same. Take your time and understand. Both of them are 2.7 million only. But because time value of money is there, no? On the left story, we are getting the 2.7 million one shot today. In the right story, you are getting it spread over 6 years. Now, do you realize this part is yet to be taken into consideration in the NPV? Everyone there? Year 0. I will go to year 0 again. In year 0, I will say, Achha, by the way, now, this what I taught you just now, this, everyone focusing, focus no here. This what I am telling you about, this. Read. They are saying that old bonds flotation cost na 9 million is still unamortized. That entire thing will be written off, means we will recognize the whole thing as soon as we refund the bond. But then the hidden entry here is, if you don't refund the bond, then this 9 million will continue in its amortized form. You are able to understand, no? The 2.7 million, that is 30% of 9 million, you will get in amortized form. Clear chhe? Sure? Okay. So now I have to put that into consideration. I will go to year 0 for this. I'll go to year 0. And in year 0, I will write in story number 1, I'll write. You're understanding? In story number 1, I'll write add tax saved on unamortized flotation cost of existing bond CI 9 million into 0.3. The entire 2.7 million we will recognize today only. Everybody clear? Entire 2.7 we will recognize today only. So if that happens, 14.4 minus 2.7, na, my outflow will reduce to 11.7. So I'll write here, this is 11.7, this is 11.7, 11.7. NPV, this becomes 11.7, 11.7, 2.7 na, so my NPV will increase from 13.487 plus 2.7, 16.187, 16.187. All clear? 16.187. Now, students, the only part left now is for me to ask you, will there be any tax effect on interest? Yes, you have been doing it since childhood. Simply do interest into 1 minus t, game over. Everybody clear, na? Rather than showing tax saving separately, na, here we will net off the interest as we have been doing since childhood. So what I will do is, interest is there, no? Interest, yeah, this thing, interest. So I will write interest bracket 1 minus t, okay, into basically 1 minus 0.3. Everyone clear, na? Interest into 1 minus 0.3. So basically 30 minus 30%, this will come to 21. 21 means what? I am spending 30 million interest, but on that 30 million, no, 9 million I am saving on tax, 30% of 30 million. 21 million is my net of tax interest. And this 36 into minus 30%, this is 25.2. Okay, this is 25.2, 4.2, 4.2. I'll take this down, and savings of interest, instead of 6 we will take 4.2. So 4.2, basically you remember, no, it was 6 million incremental earlier, minus 30% is 4 point, directly also we could have done direct interest incremental minus 30%, but we did the long cut proper way. So 4.2 into 4.767 is 20.02 million. Okay, so this is 20.02 million. And okay, I can take 0.2 1 and you will get your revised NPV minus 11.7 plus 20.021 plus minus 0.715, and that comes to 7.606 million. Everyone clear? 606, no, Divya? Check once. 0.021 I have taken, huh? Done? Okay. Over. Now I want to tell you one thing. This question, no, this, what you are doing, question number 26. Before I go ahead, tell me frankly, good, now we did replacement detailing first. What is replacement decision, incremental NPV, that concept, na, so important it was. Now I want to tell you, institute na earlier had two questions on bond refunding. This was the smaller one. Now from study module they eliminated the question. I have not, and I have kept it in your additional questions. If you can go there, in additional questions, no, you can come to question number 2. Can someone tell me the page number, please? Question number 2 of additional questions, Trans India. Additional question, one chapter I have kept at the end, if you can see. 243. Okay, page number 243. Thank you. Page number 243. Can you see this question, MS Trans India? When you read and try to understand the solution, you will go into trance. Read it once. Read the question only, don't go to the solution. Solution don't even see. Just try to get a feel of what students before you have gone through. It is like 10% more. You're understanding, 10, 15, 20% more. Slightly less added is there. So if you want, you can try this on your own. Solution is given there only. But this solution is not in my format. This is ICI solution. You don't look at that. You try on my understanding. Then see if it tallies or not. Okay. So students, all the best. Start writing. Just 1 minute. Okay. Discounting factor is KD, interest rate into 1 minus T. Hey, wait. This is not there. I just. All done? So with that we finish this module of bond refunding. We will now go to the next module, last concept of this chapter. And in the heading, please give heading convertible bonds. Module number what now? 9. Module 9. Give heading convertible bonds. Write down convertible bonds refer to those bonds which either compulsorily or optionally will be converted to a fixed number of equity shares. Convertible bond, now language you must have heard of this convertible. Convertible means it can get converted to equity shares, correct? How many shares every bond will convert to, that is also fixed. They will tell you at the start only. So generally, no, convertible bonds are issued by startups and all, new companies, because see what happens if a company, let's say there is a startup, it wants to raise money. At that time only, if it raises through equity, if it goes to Shark Tank and wants equity, then do you realize that these people will take a big chunk of your equity? You're understanding? Unless they don't have expertise and they're out and all that, that is a different case. But generally, they will put money and your valuation will be considered very low. They will put money and take big chunk out of it. So that is one problem for startups when they ask money through equity route. When they ask money through bond route, debenture, debt route, then also they are suffering because of the high payment of interest. You are understanding? Convertible bonds are such bonds where they issue bonds and they tell the investors that interest rate we are keeping low. Are you understanding? Generally, convertible bond interest rates are low because of the convertibility option. You are understanding? Na? So so what will happen? I will let's say I will give you 10 crore rupees bond. You give me 10 crore rupees. I'll keep the interest rates low and I will say every bond you hold will convert to 2 equity shares. Okay, and then what I will do, I will pay you little interest every year and I will work hard with your money to grow the company large, and when the company becomes large, your bonds will convert. Let's say you decide or I decide, let's convert the bond to equity. When that bond converts to equity, one bond will convert to 2 equity shares. Let's say the market value of the shares that you are now owning is, let's say, 30 crores. Can I say for you it is a great deal, your 10 crore became 30 crore. Now that dream I will sell to you at the start and therefore tell you that I will be charging low, I will pay low interest to you. You are able to understand? The interest will be low. So that tomorrow when I grow big, you don't need to pay the premium price for becoming equity shareholder. You will be getting fixed 2 shares for every bond you hold. You are able to understand, no? So for me, at that time, I would have grown so much that your equity shareholding in my company won't affect me that much. Till that time, you are not even a shareholder. Till that time, you are a debenture holder. Interest also is low for me. You're understanding? So it's a win-win situation. For me, the interest is low. For you, interest is low right now. But then when you enter into the equity, you have to pay less. You're understanding? Now you don't have to pay only. Your bond only will get converted to equity. Everyone following? But then you have to pray that in this my company actually runs properly. You're understanding? Now if it goes down, then also you are safe, because at least the bond is there and at least interest you are getting. You can get out of the bond anytime you want. You're understanding? Like that. They were not like that. See, if I am not able to pay interest, I will change it to equity. Now this is as I told you, convertible bonds is a very broad term. Now who converts it, who exercises the options? There are multiple layers. Listen, one kind of convertible bond is after 5 years, no, irrespective of anything, your bond will convert to equity. Now this is a compulsory conversion. You're understanding? Optional means either I or you, according to the deal, will be having the option to convert. You're getting it? So then when will you convert, when will I convert, it all depends on us. In compulsory, nothing to think, in 5 years, it will convert. Like that. Everyone clear? Okay. So now on this, we will do one question today, and the question number is 17. Question number 17. Yeah, please read this question. Can I say this bond looks like an option to convert kind of a bond? You're understanding? Here you have an option. So XYZ issued convertible debentures with interest rate of 12%. Every debenture has an option to convert to 20 shares any time till the date of maturity. Debentures will be redeemed at 100 rupees on maturity, which is after 5 years. See, students, can I say, if you remove that conversion option, it is a plain vanilla bond. Everyone clear, na? Forget that conversion option. It is are you able to understand? Normal plain vanilla. Okay. The required return is 8% on a 5-year security. As an investor, when will you exercise the purchase option? If market value is 4, 5 or 6. Now, you know what? Out of this, this entire question, I will pull out something that you understand. You all remember that value of a bond is equal to present value of all future cash inflows. This is where we started this chapter, first module. Plain vanilla bond means year cash inflow DF at the rate 8% present value. 5 years it will give me interest, 5th year redemption. 5 years the interest it will give me is 100 rupees face value into 12%. So this is basically 12 rupees interest and 100 rupees redemption. 8% means 1 divided by 1.08, 1, 2, 3, 4, 5. This is 0.681 and this is 3.993. So 12 into 3.993, 47.92, 68.1. So I will do 47.92 plus 68.1. 116.02 is the value of the bond. Now imagine, students, as of today this bond still has 5 years to run. The value of this bond today for you is rupees 116.02. Now I will write here evaluation of conversion option. Okay, evaluation of conversion option. Case 1, 2, 3. Market price per share. Now listen carefully. They are saying, okay, what if the market price of equity shares is 4 rupees? Okay. Students, you tell me, if you convert your bond to equity, every bond will convert to 20 shares, which means you will get a value of rupees 80 on conversion, whereas the value of the bond, can I say right now, is 116.02. Decision, can I say, don't convert. Are you all able to understand? What if the market price per share is 5? Then can I say on conversion I will receive a value of 100? But right now the value of the bond is 116.02. Can I say don't convert? If the market price per equity share is 6, on conversion I will receive shares worth 120. Today the value of the bond is 116.02. Convert. Everyone clear? So I will basically, I'll write therefore an investor should exercise option to convert bond to equity shares only if market price per share is rupees 6. Everyone clear? In 4 and 5 there is no point in converting. Read the question once. Now are you understanding? Check please. Done? Okay. Copy please. Question 70. Done. So simple na this looks. After all that we went through. Duration, volatility, duration of portfolio, bond immunization, bond refunding. Lull after the storm. Lull before the storm. No, it should be lull after the storm. Storm is over. All done? ठीक है. Okay. So now in your notebooks, write down, give heading, convertible bond terminologies. Convertible bond terminologies. Same module, huh? Convertible bond terminologies. Okay. It's not required. Okay. Write down point number 1. Everyone please. Point number 1. Write conversion value slash stock value of a bond. Conversion value slash stock value of a bond. Write these 2 lines. Note not required. It refers to market value of the equity shares into which each bond is converted to. Instead of price per equity share, if you are comfortable with MPS, you can write MPS. MPS into converted number of shares per debenture. So point number 1 done. Now point number 2, straight value of a bond. Straight value of a bond. In that, just write PV of interest plus PV of RV. PV of interest plus PV of RV. Okay students, remaining we will do tomorrow. Today's lecture clear. Thank you very much. Artaita, Purnida, Samja. Bye bye. Take care.